Imagine investing in stocks, only to find out that the median monthly return is zero. Yes, zero. Intrigued? Keep watching to uncover the surprising truth about stock returns. A study by Henric Bessembinder revealed that individual stocks generate returns centered around zero on a monthly basis. Half the stocks produce positive returns, while the other half have negative returns. As an investor, this zero median return statistic might make you question the value of investing in stocks. Convincing clients to invest in equities could become an uphill battle. Volatility is another crucial factor to consider. On average, the annual standard deviation for stock returns is about 50%, meaning stock prices can swing wildly throughout the year. Applying the 95% confidence interval, an individual stock's return could vary by roughly plus 100% in a given year. This level of uncertainty can be daunting for those seeking stability. Despite the short-term ups and downs, stocks are primarily intended to be long-term investments. The journey toward long-term wealth creation involves navigating these fluctuations. When we shift our focus to long-term individual stock returns, the findings are not comforting. Over the long run, 55% of U.S. stocks underperformed U.S. Treasury bill returns. More alarming is that the most common outcome for individual stocks was a 100% loss, complete failure. Investing in individual stocks is a high-risk endeavor, even in the long term. Traditional analysis of stock performance focuses on central value and volatility, often leading to a discouraging narrative about investing in individual stocks. If returns are largely zero in the short term, highly volatile in the medium term, and risky in the long term, why would anyone invest in stocks? The answer lies in the third parameter for assessing stock performance: positive skew. This crucial component explains why stocks have historically outperformed other investments. Stock returns are driven by human behaviors: fear, greed, speculation, optimism, and panic. This emotional backdrop creates a positive skew in stock returns. While the downside for any stock is capped at a 100% loss, the upside is theoretically unlimited. An investor might lose all their money on one stock, but another could skyrocket. This asymmetry in returns, the fact that gains can far exceed losses, generates positive skew. Combined with multi-period compounding, it explains much of the long-term value of investing in stocks. Examining stock return distributions, the long-term value from investing in the market comes primarily from tail events, rare but extreme outcomes at both ends of the distribution. The long, positive tail produces outsized returns that more than make up for the smaller, frequent losses. The more positively skewed the return distribution, the higher the long-term returns. Traditional portfolio management strategies focus on eliminating volatility, aiming to create a more predictable and less volatile return stream. However, this approach reduces positive skew and overall returns. A typical managed equity strategy eliminates all stock losses while capping upside returns. For example, a managed S&P 500 fund avoids annual losses but limits returns to less than 7%. Avoiding emotional tail events means missing out on the returns that drive long-term wealth creation. Investors who focus too much on smoothing returns end up with lower returns over time. To truly benefit from stock investing, it's necessary to embrace both the emotions and rewards that come with positive skew. Learning to live with tail events is crucial for long-term success. The most successful investors recognize that volatility and tail events are unavoidable and crucial for achieving high returns. Learn to love, not fear the skew, and unlock the full potential of stock market gains.